Some businesses look unstoppable. Every quarter, the profits rise, the headlines grow louder, and investors celebrate another record year. But beneath the surface, something very different may be happening. Because higher profits do not always mean a stronger business. In fact, some companies only grow because they constantly consume more and more capital, more factories, more debt, more employees, more expansion. Like a machine that burns twice the fuel just to move slightly faster. Around the late 1970s, investors like Warren Buffett began looking at businesses differently. Not by how large they became, but by how efficiently they produced profit. That distinction changed investing forever. Because if a company needs endless new money just to maintain growth, then the business may not actually be improving. It may simply be getting heavier. And this is where many investors get trapped. They confuse growth. So how do intelligent investors separate real business strength from the illusion of growth? One answer lies in a deceptively simple idea: return on equity, or ROE. At its core, ROE measures how hard each dollar inside a business is working. Think of it like an engine. Some businesses require enormous amounts of capital, yet produce very little additional output. Others remain surprisingly lean while generating exceptional returns year after year. And over time, that difference becomes enormous. Because the best businesses are not necessarily the biggest. They are the most efficient. They turn small amounts of retained capital into large amounts of future earnings. Quietly, consistently, almost effortlessly. This is why certain companies compound wealth for decades without constantly needing outside capital or excessive debt. Their internal economics are simply stronger. And that strength often hides beneath the surface, invisible to investors chasing excitement and rapid.
But even great management has limits, because businesses do not operate in isolation. They operate inside industries. And some industries behave like a powerful tailwind, while others feel like riding directly into a storm. Imagine two cyclists. One is pedaling with incredible effort against violent wind resistance. The other moves forward almost effortlessly because the wind is carrying him. Business works the same way. Sometimes an entire sector benefits from massive structural change. Technology, digital infrastructure, clean energy, consumer behavior shifts. When the economic environment itself becomes favorable, even average companies can appear successful. And when the environment turns hostile, even strong operators can struggle. This is why intelligent investors pay attention not only to the business itself, but also to the direction of the economic wind behind it. Because progress becomes far easier when the industry logic is on your side.
In the end, great investing is rarely about chasing excitement. It is about understanding business quality. The market often rewards appearance in the short term. Rapid growth, aggressive expansion, record profits, market hype. But over long periods of time, capital efficiency tends to reveal the truth. Weak businesses eventually become burdened by their own weight. Strong businesses quietly compound. And the investors who understand this difference begin to see companies differently. not as stock symbols, but as economic engines. Because the real goal is not simply to find businesses that grow. It is to find businesses capable of producing more, while requiring less. That is where long-term wealth is created. Quietly, patiently, and often far away from the noise of the market.